If you're looking for the most effective strategies to trade price action, I want your full attention because I am about to reveal my most important tactic after the 10 years of the price actions trading. We are not going to talk about the support or resistance, candlesticks patterns or charts patterns. I will share something more important, how to read price actions momentum and how to decode the market rhythm. And if you wanted to show your support, please leave a like to help us with YouTube algorithms and turn the bell on so you don't miss when the new video are released. Trades often have this big obstacle. They aren't able to recognize if the market today is tending or ranging. There's your first lesson. The momentum you recognize that the type of your day you are dealing with when you can apply the appropriate methods for trading. If it's trending, pullbacks are the best choices. It doesn't matter where it's the first or second pullback, one bar pullback or complex pullback. If it's trading range day, you only enter an extreme of the range, wait for clear confirmations and stay out of the middle because it can be very choppy. In order to read the market and to evaluate the price momentum, I use price actions. The main reason I prefer price actions instead of the employing indicators is that indicators will lose their powers when the market is not trending. They create all kinds of the false signals on the range day. That is the big problem because the market is rotating in the sideways motion over the 70% of the time. One thing I discovered through many years of the trading is that trading range is surprising predictable. The reason behind this is because the market is in the zone of the fair value of the price, where the buyers and sellers are somewhat passive. Here are several strategies which can help you to potentially tell what type of the day is ahead. First, we will talk about the price actions during the 10 days. First, trends and follow-ups on the trading days, where is an uptrend or downtrend. The bar which indicates the trend usually have decent following ups. Markets has the rhythm like music. So you can sense the urgency in the tempo and the strength behind every bar when it's forming. One side is daunting the other one, and this should be fairly obvious. In a strong uptrend, the chart is filled with the green trends bars with the average size body but closing highs. Bars are slowly moving upwards, which can create the parabolic curve. Any pullback red bar is short-lived with the narrow body and the long wicks at the bottom. At the glance, there are just simply more green bars than the red bars. When the strong uptrend is in the progress, it is very hard to make money selling. But for buyers, you should see a profit not long after you entered. The price is pushed up and nobody is talking profit until they reach a fairly strong supply zone. Any counternet attempt will fail and become the most reliable setup for resume the thread. The week of the candles is very important in the price actions trading. It shows both rejections and trends. Is the high and then truth about the domination in the uptrend. You should see the long wicks and the bottoms of the bars, not on the top. It means any ceiling is being rejected and pushed up. The same principles apply for the downtrends. More consensitive red bars with average size body and wicks on the top of the bars. Any green bars pullback is small and short-lived. Here we have the very strong downtrend. Here are a few green bars and many bearish bars. The close of each candles is lower than the previous closes. It's a parabolic curve rather than the box in a trend today to market controlled by blues in the often characterized by the following bar patterns. First, then obvious one is that we have more bull bars than the bear bars. When he see this on the chart, this means that the bull have more power and are inclusively moving the market hours. Also, we will see consensus bull bars. Consensus bull bars is a clear indication of bullish momentum in a bull market. The green bulls are bigger than the red bulls. When he see this on our charts, that's a sign that the bulls have more strength than the bears. Also, during the bull controlled market, we will see the green bars closing near their highs. This suggests a good momentum on the upside because the bulls are trying to maintain the prices higher. We will also see a lot of the wicks below the green bars. This also represents a good signal that the bulls are in control of the market and that are trying to push the prices upwards. When we see that the green bodies getting bigger, this signals is a clear bullish momentum. Second, the old school higher high and lower low. First, the following up bars should be breaking out previous bars. For example, each following up green bars in the upturns should have higher low and higher highs and higher close to the previous one. Vice versa. For a downtrend, red bearish bars should be making lower lows and lower highs and lower close than the previous bar. Another international is based on the structural pattern, the pivot point of each side. Price never moves in the straight line. It moves in waves, and each waves will create a point pivot on the chart. These pivot points can often be found in the pullback of a trend. They are important turning points which represents zones of the demand supply. The best way to use these pivot points to identify the thread is to create a thread line by connecting them with straight lines. You don't need to advantage knowledge to draw the complex trend lines. Just connect lower and higher lows. You get a simple trend line pointing in up directions. For downtrend, correct any height and lower highs. These trends give you both of the directions of the trend and create reference points for the support resistance for future price momentum. Third, the dynamic support resistance tools, namely AMI exponential moving average. I personally use the 20-period EMA on my chart when trading price actions because it's reacted to the price quickly and follow the price actions closely. There are many ways of using the EMA, but I found the two methods that are quite effective. First, I use the 20 days EMA to give me the broad idea of what expert of the day, whether it's trending on the wrangling for training days bars usually stay consistently above or below the side or EMA, most of the time not touching the EMA for hours until a deeper correction. For range day, it's very obvious that the price interacts with the EMA very closely. Another usage for EMA is to watch the price actions around the EMA when it's touched and based on the reactions you find tradable setups. EMA isn't like the trend lines a straight line. EMA follows the price and it's several as the strong support resistance reference points, but it only works best when the price is trending in one direction. When price moves sideways, EMA loses its efficiency and does not produce any reliable setups. As long as the price stays above the EMA, you will only buy, never sell. The opposite is the true for downtrend. One of the trade model I employ often is to enter the first deep pullback. It's a strong trend. Price goes too far away from the EMA and do not touch for hours. But when it does for the first time, this deep pullbacks is a very reliable setup to resume the original trends. Some experts call the EMA the meal. When the price moves too far away from the meal, it can create the rubber band effects and the price would strange back to the EMA. Trades watching for the EMA know that the probability of the first pullback of the strong trend to turn into the reversal is quite rare. So when the price returns to the EMA, they would enter hoping the original trend will resume. Not let's talk about the trading range sideways price actions. Trading range can be very tricky because it's very difficult to distinguish between the range and the trend. It's understandable because they have some similarities. The relationship between the trend and the range is that they are interactive. One can survive without another. Trend is essentially a breakout phase. Range is essentially a consolidations phase, and the market is rotating between the trend and the range. So, how do you actually read the price actions range? First, weak trading range is the field with the weakest, especially more on top on the bottom of the approximate range permanent. The reason behind this is back-to-back failure when the price is being pushed up in the upper boundary of the range. Sellers are waiting it goes to see how far price can go. The higher it goes, the more profit of the sellers when they see into it. It creates a vacuum effect. When the price becomes the expensive, sellers will jump in and sell into buyers, pushing the price towards the lower boundary of the range. Entering at the extreme offers great risk reward ratio for the traders. You should try to remember range days because they are somewhat predictable. And the first step to look for the many long weeks around the edge is the range. Weeks are failure. Top week means buyers failure, and the bottom weeks means the seller's failure. Remember this, range will have multiple failure breakdown attempts before the real breakdowns. When the real breakdowns occurs, you can miss it because it convenes both in the volume and the bar size. Any interior breakout will fail within a short time, generally within 5 bars. Look into which within this range. Observe this area failure with dodges and the bars that are overlapping. This bar shows the real breakout of the what range the bar is focused. Large in the size, closed, high, and with the minimal wicks. Second, alternative between the bullish and the bearish trends. These both sides are active in this no feelings of the continuation of the either side. There is no consistency in the range from the either side. The red bars and the green bars are somewhat equal in quantity. The strange is weak in the shines and dies very quickly. Often you will see the gigantic bar in the range. It takes over the whole space when the following up in the opposite sides. So no momentum continues and the trades trying to trade the first bar are on top. Price move in the opposite directions again. There is no sentence of the consistently. Range days can create a weird feelings that makes is not really active and it feels lazy. But actually, both sides are very active in creative balance between the buyers and the sellers. That's why the price is not breaking out to any directions. All these setups which work best in the trend trading are not losing their magical power. Remember this when then trading range patience. Wait for the confirmations and prove the side of the actual failing. Then enter the extrements. Third, dodges and the overlapping price actions. When you start to see lots of the dodges and the bars on the overlapping sideways market, it's probably ranging. The dodges are the earlier sides of the range information. The doji is one bar trading range is essential and it has many variations Gearstones, Dragonfly, Harmer, Hanging Man. This means it's not important they all indicate the same character indeed. Overlapping price actions simply means the size of the bars enter similar or inside of each other. Price is moving sideways. It's not going anywhere. Somewhere you will see two or more beers have the same high or low. Then you look to your left and you will find the past corresponding price actions that stopped at that level also. This means there are strong supply demand zone for that level. So whatever you see two or more bears have the same high low market that levels and watch for the reactions when the price revisit that level. Look for reliable setups of real breakout or failure breakout. 4. The 20 EMA when price is trending to the strong fast, it's hard to EMA to catch up with the price. Therefore, is the strong trend, there is the distance between the EMA and bars. In the trading range, it's the opposite. There is a lot of the touching because price moment in the range is not very validating. Most of the time it's not going anywhere. The EMA cuts through the range often when the middle the 20-day EMA is like to exit when the price is moving around it. There is one scenario to note there. When the range is about to break, watch the price actions closely and you will notice the EMA is somehow holding the bars and push them into the breakout directions. For an upside breakout, price will stop around the middle of the range, around the EMA. Vice versa for the downtrend. Price will test the EMA and will be pushed to the downside. Being able to read the price action chart is important to make the right decisions. The problem many trades have is the overcomplicated things and get easily confused, or they don't have the process in the first place and don't know what they are looking for. Now, your job is to open your trading platform, choose the one market, and start analyzing price actions. Using these techniques, just see. I could have the mentioned charts patterns like the flags or the training, but these are just ranges. I could have the mentioned stands of the candlesticks patterns like instead bars or price ring lines, but again, these aren't important right now. What's important is the code, the market rhythm, to distinguish a trend day from the range day and to read price momentum. This is the best price actions approach. As always, if you get any value from this and learn something new, leave us a like to help us with YouTube algorithms and to also make sure to enable notification to stay in touch when we upload new videos. Until next time.